Good day, everybody. Well, it's been an interesting couple of weeks since we last spoke. So one of the key features within that couple of weeks has been the ongoing strength and the sort of discussion topics around the US dollar. So one of the questions I think a lot of people are asking at the moment, particularly in the retail world, is how much further the dollar can run. So, first of all, let's start with some basics. I mean, you can see here on the right, we've got the Bloomberg Dollar Index looking very strong. It's been a good run. And since the start of 2021, the dollar has had a pretty stunning run higher, to be honest. So this is after the Fed is committed to fighting inflation, more or less above all other considerations, to be honest. And on the back of that, with an aggressive central bank determined to hike, obviously the dollar has found further support. I mean, the expectations for US yields have continued to rise, and ever more aggressive hikes are being pushed into the commentary as well from the Fed. 75 basis points expected at the next meeting, for instance. So, the structure of the dollar has got some fundamental support areas in it. And so, the market has been keen to hold dollars because of the, because of the strength within those fundamentals. But what about other currencies? I mean, if we look at the chart on the right, we've got the different pace of central banks. We've seen many other central banks like the Bank of Japan and the ECB have been very slow, to be honest, to react to what is clearly an inflation problem, more so in Europe than in Japan. But even so, what this creates is what we call a positive yield differential to the dollar. So basically, if you sell yen or sell euro and buy dollars, you actually get paid for actually being short what seem like relatively weak currencies with a less aggressive central bank, probably hiking less than the Fed. It makes pretty clear common sense to be long dollars in that environment. So the idea of holding dollars and being short euro yen is what we call a positive carry. Now, this is a professional term for exactly what I've just explained. That positive carry pays you for holding dollars in the longer term or even in the medium term. And so therefore, the dollar became a popular product to have on your portfolio, along with other things. But the dollar was king. And at the moment, it looks like it may still be, but we need to sort of look into that as the different pace that we see from the central banks here continues. So again, this is all part of how much further the dollar can run. But, the key here is can the Fed dollar, after all this huge move, continue, and what would keep it continuing? So the Fed is solely focused on inflation. We know that. And even if it peaks now, getting it back to 2%, which is their target, is going to be extremely difficult to achieve. They're going to have a run of very low CPI data to get it down there. So whilst it may peak, it's probably not going down fast. Finally, the ECB is starting to hike this week. We're hearing they're going to do 25 basis points on Thursday, but there is talk of them possibly doing more. So that could be an interesting factor to kick in. But there are some indication that foreign demand for US fixed income is also waning. So we're not seeing the big buyers turning up in the US bond auctions, for instance, which actually puts pressure on bonds, which takes yields higher, which then is attractive for the dollar again. So when will the dollar run out? Will the dollar run out of steam soon? Well, if we look at the chart on the right, the long run trade on the dollar has clearly been one of those where we can see that there is more potential upside. Now, there was a famous saying back in 1971 where John Connolly, the then Treasury Secretary, said the dollar is our currency, but it is your problem. And this was when the dollar was extremely high. Now, so do the US care that it's a strong dollar? Well, to be honest, I don't think they do. So what happened? What are the dangers if the dollar does stay strong? Well, the world has a supply issue at the moment and therefore inflation issues. But in a world where demand is higher than supply, the country doing the most to generate demand, which is the US, is just exporting its problem, and its problem is inflation. So it's the others that pick up this inflation rather than US. And don't forget that commodities are generally priced in dollars. And so therefore the rising commodity prices affect the US less than it does elsewhere. So as for the US, this clearly helps in keeping imported inflation down. So a strong dollar is actually quite good for the US. If we look at Europe, what does that mean for weaker currencies? As the weaker currencies fall, this means imported inflationary pressures will continue. And I think the ECB is getting a bit upset with how weak the the euro is becoming. Excuse me. So this euro hitting towards parity has started hearing sources comments that they might look at bigger hikes to try and move this away, because a weaker euro actually damages or underscores the inflationary problems. And so these depreciations also create capital flight away from places like the euro into dollars. And if we look at this chart on the right, European inflation is actually, way out of control, really. And so that there should be more being done by the ECB. But of course, they have some problems with that over what it does to growth as well. But one of the positives that comes out of a stronger dollar is that a stronger dollar usually presses quite hard on commodities. Now, if we look at this copper chart, for instance, this is a weekly copper chart on the right. I mean, look at that fall there. That is quite dramatic. And so therefore, if commodities start coming off due to a stronger dollar, then the whole trade, inflation trade, could start to peak. And this is what people are beginning to look at. But the dollar commodity relationship tends to act as a cushion for the global economy, reducing inflation. So basically a higher dollar, lower commodities, less inflation in the system, less inflation being pushed into manufacturing prices and such. But unfortunately for supply strapped commodities like oil, which still has a supply issue, this relationship appears to have been sort of rather left behind, if you like, or no longer applicable at the moment. So is the inversion of the 2-year and 10-year spreads a sign of a US recession? Well, what is an inversion of the yield curve? Well, let's start at the beginning. Was the Fed too late to realizing this inflation wasn't transitory? Yes, it was. So basically, if you can look at this chart on the right, we've got the Fed tackling inflation, but look where inflation is. I mean, they've got a long way to go to get inflation down. And so this is the problem, that the Fed is being quite aggressive. Now, it's going to be this aggression towards catching up with inflation that is possibly going to do the damage to growth outlook. And the inaction at the early stages of inflation has really damaged the credibility of the Fed on this. And I think, they are now playing catch up. Now, this talk of yield curves is a little complicated for many people, but there is a point here that, the 2-year, the front end of the curve is far more susceptible to interest rate movements, whereas the 10-year is more susceptible to what markets think of growth. And therefore, the 10-year drops and the 2-year yield rises, and that's an inversion. And we've got a chart on that on the next slide, I believe. So we can take a look at that. But the ultra aggressive Fed is creating this inversion. And Powell has actually conceded that the Fed may trigger a recession. Now, he knows this, but this is the chart at the bottom I want to talk to you about. This is the 10-year yield dropping below the 2-year yield. One would expect longer data yields to be above those at the front. They're not. And this has been a precursor many times for future recessions. So this is the problem with these aggressive rate hikes, is the damage it does to the economy whilst they do it. But one caveat to all of this is that this is actually what the Fed wants to do. This is what is called tightening financial conditions. And tightening financial conditions is hitting demand and therefore growth. So this is all part of the plan. The Fed is comfortable with this. And so therefore, we shouldn't really fight it. So, as I said, the 2-year reflects the interest rate policy, but the long end reflects the growth outlook. So a full-blown US recession certainly could derail dollar strength. That has to be said. So that could be one of the things that actually tops the dollar out. And we may see catch up from others. We've seen the Bank of Canada move 100 basis points at one meeting. That is catching up and in fact ahead of the Fed. And so, what we got to do is understand how badly they miscalculated this and what the damage of this catch-up policy, because the US has only really seen a soft landing of their economy when the Fed has been ahead of the curve and preemptively cutting rates, whereas now they're behind the curve and chasing the markets. So I think, what we can do is have a quick outlook. Let's do a quick weather forecast here. How much will this impact the dollar? I don't know, but we have The weather forecast for me is it's looking cloudy with a chance of recession. And there is certainly a danger here that what the Fed is doing is negative for growth. But don't forget, there are weaker economies out there than the US as well. So can the US take these hits with higher rates better than others? Well, our weather forecast I'll leave you with that weather forecast because there is a lot of doubt in this at the moment. But we're trying to look at the bond markets and the financial markets that we do have to get a gearing or an idea of when this slowdown may actually take a really nasty hold. And that could be the change for the dollar. And until then, it seems dollar is probably king.